Computer, right. We're on. Right. Thank you, everyone. We've got Daniel Jordan with us today. Thank you very much. He's been with us before. Today, we're going to talk, hopefully, Daniel, on basic options. We've had a lot of our members the last few months have come in questioning, obviously, with volatility up above 20%, what we should do with options. And also, the issue we have is where they've gone wrong with buying options or where they've gone wrong selling premium. So we're going to go right back to the bark and go back to when we were blue buttoned almost, and how and what we can buy on options and what they actually go. So I'll leave it, start with you, and I'll come back and ask you a few questions afterwards.
Sure. Okay. Well, basically, I think we discussed this one of the last times, actually, that over 70% of options bought expire worthless. So it's not that options are useless, and quite often people are happy for them to expire worthless because they're buying them as an insurance premium against a future outcome that they don't necessarily want to happen. So that's understandable. But it shows that being a seller of premium, i.e. selling options, can be very profitable if used sensibly with a hedging strategy in place. What you don't want to be doing is just selling naked options because you've got a gut feeling that you're 100% right and nothing could possibly go wrong, because that's like walking in front of a steamroller picking up pennies. You know, it's going to last for so long, you're going to do well for a period of time. But when it goes wrong, if you have no hedge in place or no understanding of what you're doing, it will not only wipe you out, but probably everyone else in the room that you're trading in. So have a look around at your mates next to you and make a decision now that you're not going to risk their livelihoods, futures, houses, etc., by trading them recklessly. Now, that said, any derivative or any financial instrument, if used aggressively or irresponsibly, can be dangerous. The same would be said that if used sensibly, strategically, and with a clear plan in place, can be a phenomenal tool for hedging your exposure or taking a view on the market and getting exposure to a market, and also leveraging a trade that otherwise you may not make as much on as if you were to use an option. You know, that you can use it in a variety of ways, such as an exit strategy for a trade that you don't want to get out of all of them. Let's say you buy Tesla stocks at, you know, $100. And it goes up to $120 and you made 20% and you're thinking, wow, look at me, I'm a hero, I should get out of these. So if you weren't to use options, you just sell your Tesla shares at 120 and that's it, happy days, you've locked in 20%, you've done great. If that stock then goes to $200, $400, $600, you're feeling sick. Now, equally, if it goes back down to $100, you're feeling like a hero because you've locked in the profit. With options, if you were to buy a call, let's say you were to buy a 115 call in the Tesla shares, your potential is to give away let's say you buy a 117.50 call. 117.50 put. You buy one of those, buy a put. What you've done then is I've messed it up, haven't I? If you were to sell a put, a 117.50 put, what you've done is you've sold someone the right to go short Tesla shares at 117.50. And what that does is that means that if it keeps going up, they're not going to exercise that share and you're still long the shares. But if it goes down to below 117.50, they're going to exercise it and you're just out of your trade, basically. It's like putting in a downside stop, but you're receiving premium for that. So as the stock continues to climb over time, you can continue to sell those puts, the same put over and over, and it'll only get exercised when the price hits that. So you can continue to collect premium whilst the share price is rising, and it's only going to stop you out once that stock option is exercised. So that's a great way to use puts, and equally on the reverse side, calls as well, if you're short a stock and you want to do the same.
Okay, I mean, one of the things that's great example, we have a lot of people come in who obviously, and the interesting thing is that when a market is poised, so to speak, in a way now, obviously buying calls where
Yeah.
it's going to go up now, saying in the Dow Jones we'll be reaching the all-time highs again for the 50th time this year,
Yeah.
and Nasdaq and the S&Ps. Calls are expensive.
Yeah.
Why are they expensive? Question number one. And two, why are puts now cheap? Relatively.
Well, well, it's strange to me that puts are cheaper than calls. It really is, because this market, I think a lot of it is momentum, and people have got carried away with this whole euphoria of the market can only go in one direction. And it's funny because I know people who, when the market had when coronavirus first came out and markets were still going up, they actually wanted to get short the market, but they bought straddles. So they bought puts and calls, expecting to exercise the puts, but in fact ended up exercising the calls and making money that way. So they put a strategy on that they didn't even imagine using the upside on, but that's actually what made the money. So to just do one or the other isn't always the best strategy. You should look at something that's all encompassing, especially if market's stagnant or moving sideways. You want to be catching any breakout. You don't want to just limit yourself to one exposure or one exit or one entry. So that's one of the first things to consider. But also the pricing of these things is based on demand. Ultimately, all markets are priced on demand and supply. So if demand for calls outstrips demand for puts, then the price of those is going to be higher. And equally, a lot of these companies that are happy to sell puts are already intrinsically long the stock. So therefore, if it goes down, it's just them getting out. It's their getting out of. They're not necessarily going to suddenly become short or suddenly become long because you've exercised the puts. Whereas with the calls, not many companies are short these stocks. So I think that's where it's affecting the upside price of calls.
Okay, and the one other important question, which I find for most people, and as you mentioned earlier on, the picking up pennies in front of steamrollers.
Yeah.
When we have volatility, and it is very attractive, and you can pick up the quick money, and if you want to go over it very quickly, in the process of when you're buying premium and when you're selling premium, and obviously you explain it better than I will, in a simple person that, say for instance, the FTSE is trading 6,400, which it is right now in its highs, and I want to buy a 6,000 put, i.e. I want the market to go down, and they're going to charge me 25 ticks for that. The most I can lose if I buy premium is the 25 ticks.
Absolutely. Okay, so basically to explain,
and obviously the alternative to that, if I sell premium, what can I lose?
Right. So when you buy an option, you buy the right but not the obligation to buy or sell a underlying instrument at a future price at a fixed cost. So your cost of that option is fixed to the cost of your premium. So that's your maximum downside. If it costs you 25 ticks to buy 10 calls or 10 straddles, then the maximum you're going to lose is your premium, i.e. 25 ticks, times as many of the instruments as you buy. Let's say you buy a 10 lot, it's going to cost you 250 ticks. Selling an option is the opposite. You sell the obligation basically on the right for someone to buy or sell that product at a later date. So you sell them the right and you have to honor that. So if they have the choice to exercise it, you don't have the choice as to whether they do or not. So in that sense, you are limited in selling options to the premium you pick up for selling that option. So your maximum upside is the premium you receive. And in theory, without a hedge, the maximum downside you receive is unlimited.
Exactly. And then that's the crux of the argument to me.
Yeah. So the example of that would be way back in the days when Lloyd's syndicate started opening up syndications, and they got people to invest in all these crazy high risk ventures that all of them inevitably went okay. And then you had Piper Alpha explode, the oil rig out in the States. You had the Challenger rocket crash, and I think you had 3 hurricanes. And basically all of these names, lots of them are lords and ladies for the House of Lords and stuff, lost everything because their liability was unlimited. There was no cap on what they could potentially lose.
Great with that. The other question, and obviously one that a few people learned a harsh lesson, I think a few weeks ago, obviously during the US election, is the fact that the options you buy and the time and the duration are obviously as important as the nomination of the put or call you buy. And I think that, I mean, you can definitely buy weekly options. I don't think you can buy daily options, but you can.
You can buy daily, you can buy dailies,
But I think the argument being is that choose wisely, because what you think is nothing worse than that, and is that if you do buy so before the election you did buy a call on the Dow Jones and you bought the wrong one, you could see the market, for instance, the Dow rallied 14-50% a month, and you bought the wrong option and you've actually lost some money.
Yes, I mean, listen, I
think for a lot of people found out they actually, although they did buy the call, they got it half right. They just bought the wrong bloody one.
Yeah, I mean that's why above 70% of all options expire worthless. Yeah, you know, most.
I think it's very hard for the people because they think obviously it's November. I'm going to buy the December call. Probably in theory they should have bought March.
Yeah,
and then I think
again the further out the duration.
Yeah, I'm not sure on options, but the time erosion on options is quite fierce as you come closer to the date.
Yes, and closer to, you know, and closer to being in the money as well. You know, you do have to watch the Delta and the Vega and the gambles on these things. But
all of a sudden, we're starting to speak Swahili with your Vega and Delta, and I think that's what people have to learn. And
yes,
I know it's not Swahili.
Yeah,
when you
it's basically it's value erosion. You know, the value of your option erodes over time, and the closer you get to expiry, the quicker that erosion becomes.
Yeah.
So unless you're deep in the money where it acts, you know, one-on-one as a future, but if you're far out of the money, the likelihood of that event happening is decreasing. So therefore, the value of the instrument you've bought or sold is also decreasing. But a lot of it is as well, the further out you go, because there's more time involved and more time for the event to happen, it's going to be more expensive. So for instance, if you said, you know, I want to buy an option for Norwich City to win I think Norwich City are going to win the Premier League next year. You know, someone sells you an option, it's going to be very, very cheap. But if you said to them, I want to buy an option for Norwich City to win the Premier League, well, when do you want it for? Well, no, I just think they're going to win the Premier League one day. Well, that's going to be a expensive option because the possibility of it happening is, you know, the time isn't concise and constrained. So listen, the majority of people selling options, don't forget, are market makers. So it's very rare that you'll find options that are mispriced. They're priced to what the market values them today. You may think that that's incorrect, but the valuation that they come up with and the formulas they come up with make sense in the current market. Because what you've got to think of is if I'm an options market maker and I'm selling you options, it's not me saying, I don't think what you say is going to happen is going to happen. It's me saying, you may be right, and I'm prepared to sell it to you at this price, because by selling it at this price, I can hedge that option in the market with X, Y, and Z at this price and still leave myself a margin of profit. So it's not, someone selling an option isn't taking the opposite view to you. They're adding a premium into the sale of that option that they then hedge off so that they're protected as well.
Okay, great. And I think it's quite weird that, you know, for a lot of our members who are going back 6 months ago, they possibly wouldn't even looked at an option. And it's weird that, you know, wind on the 6 months, few of them have trade options. And as I said to you before, especially with the popular of Robinhood shares in the US coming through, they're all now the flavor of the month, or the fashion of the month going into 2021 is obviously how much value people have had in trading things like Apple, Tesla, you name the FANGs, everything else. that's where the Ferrari money, so to speak, is.
Yeah.
So the risk on whatever it is, the risk is there. But obviously, we've seen the volatility at 230 on these individual stocks. I think yesterday Tesla was 5% for 2 minutes, and we can name numerous others as well. Therefore, our members are obviously streetwise and realise buying a call or a put is a cheaper option, and B, probably better value for their money in that they can wipe out 20% of their shares in 2 minutes flat.
Yeah. I mean, and talking of Ferraris, Ferraris go bloody fast, and when they crash, it's normally ugly. And it's the same with chasing after stuff that you either don't fully understand or haven't learned how to hedge properly. You need to read as much up about this as you possibly can, because when it goes wrong with options, if you're a seller at premium, it can go wrong very, very quickly, and it can be very painful and extremely expensive, and quite often wipe people out. This isn't just you go away, lick your wounds, come back tomorrow and start again. It can be properly ugly. So do not be selling premium if you don't fully have a clear and concise understanding of the risk that it puts you at. And certainly if you don't have a hedging strategy behind that exposure.
Brilliant. Cheers, Daniel. And I think that's probably the best lesson we've come out of this. Your last statement, in that, obviously from day trading point of view, of which you've traded a lot.
Yeah.
We don't tend to risk more than 5 or 3% of our daily account, whether you've got £100 account or £1 million account.
Yeah.
And I think, like you said, when we're trading some of these individual stocks, and obviously something like cryptos at the moment, you're having to risk more than 5% because that's its daily volatility requirement. So therefore, like you said, you've got to be positioned inside to say, I'm going to accept this 10% challenge, or even 20% challenge, or last Wednesday was Bitcoin 32% challenge.
Yeah.
Whatever it was, is as you said, if you're making 32%, you're happy, but if you're losing 32%, it's going to take you a long time to recover your confidence, and or even attempt to make that money back.
Yeah, absolutely. And listen, it's a lot easier. It's a lot easier to, a 32% gain is different from a 32% loss. A 32% loss takes you a lot longer to get back. Because it's a larger percentage of your account.
From a day trading point of view, you don't come in the day to say I'm going to make 32% of my account in the next 2 months.
No. And equally, if what you're currently doing is working, stick to it. By all means, increase your knowledge, learn more, read more, experiment with stuff. But if what you're currently doing is working, don't look to change it. If it ain't bust, don't fix it. Add to it by all means, but stick with your bread and butter, what's working for you, what's paying the bills, what's building your account, and then put X amount of that account that you're building aside to train and learn and practice and trade. Don't be doing it with the core part of your account. Use this as like you would learning a foreign language, put X amount of time into it a week, and, don't expect to be fluent tomorrow. All
right. Cheers, Daniel. Always a pleasure. We look
Never a chore.
For you doing another one soon. The only fly in the ointment was Norwich City.
Yes, clearly.
Rumours they play football, but I'm not sure what league they're
Mate, sitting top of the championship at the moment.
Well, we are.
Championship.
Yeah. Okay. Speak to
nice one.
And we'll
all the best
later on with Mr. Gordon on our crypto one.
Happy days. Listen, send him a regards. Stay lucky, lads. Take care.
Thanks a lot, Daniel.
Cheers, mate. Bye-bye. Bye.